Good evening, and welcome to tonight's market wrap. If I had to describe today's action on Wall Street in one phrase, it would be a tale of two markets. The Nasdaq Composite surged 1.2% to close at 26,402 points, and the S&P 500 gained 0.58%, both hitting new all-time highs. But the Dow Jones Industrial Average eked out a loss of 0.14%, closing at 49,693. This tells us that money is not flowing into all stocks. Instead, it is extremely concentrated, pouring into the artificial intelligence and semiconductor sectors led by Nvidia, with some spillover into cryptocurrency-related names. This is not a broad bull market, it is a risk-off style of herding into a single, high-growth narrative. Let's walk through the global path today. In the Asian session, mainland Chinese markets were weak. The Shanghai Composite fell 1.52%, and the Shenzhen Component dropped 2.14%, completely ignoring the overnight strength in U.S. equities. This reflects deep domestic concerns about the macroeconomy. However, Hong Kong-listed Chinese stocks showed surprising independence, with the Nasdaq Golden Dragon China Index surging nearly 4%, led by a big rebound in Alibaba. Funds made a clear choice within Asia, dumping assets tied to the local economy while buying into the global tech wave and expectations of improved U.S.-China relations. European markets then picked up this optimism from Chinese stocks and amplified it across the entire tech sector. The Stoxx 600 rose 0.8%, driven by technology and pharmaceuticals, essentially filtering out the bearish signals from China and aligning with the global tech narrative. Then came the U.S. Open, where this divergence was pushed to the extreme. The Nasdaq and S&P 500 opened higher and rallied to new records, led by tech giants, especially Nvidia. But the Dow, representing the traditional economy, was weak all day and closed in the red. The capital flow was crystal clear, out of value and cyclical sectors, and into AI and semiconductors. The drop in the VIX Volatility Index to 17.26 masks a massive fracture beneath the surface. This is an index bull market driven by a very small number of stocks. The key inflection point today was the huge divergence between the A-share market and Chinese ADRs during the Asian session. The emotional leader was the U.S. semiconductor sector, particularly Nvidia. The A-share market was clearly the drag. What data or news did the market simply ignore today? It completely disregarded the hotter-than-expected April Producer Price Index, or PPI. In normal logic, higher-than-expected inflation data would reinforce the Federal Reserve's tightening bias and put pressure on growth stock valuations. But the market didn't care. This is a classic case of ignoring bad news, indicating that the current market is not being driven by macroeconomic logic but by a powerful industrial narrative, the AI revolution. The market is in a state of selective blindness and is extremely strong. My forecast yesterday warned that tech stocks were strong but structurally fragile, and to be wary of a bull trap reversal. While the market did rally, the Dow's decline and the A-share weakness confirmed the structural fragility. My error was underestimating the extreme degree to which capital would herd into a single theme within a fragile structure. This is not an increase in overall risk appetite. It is a risk-off form of risk appetite. Amid rising global macroeconomic uncertainty, capital is not embracing risk, it is searching for the most certain future growth path, which is AI, and treating it as the only safe haven. This has led to a drain of capital from all other asset classes. The market's pricing priority has temporarily shifted from macro interest rates to the Industrial Revolution narrative. A critical new structural signal has emerged, the extreme decoupling of the index from the underlying market breadth. The Nasdaq is at a new high, but the percentage of advancing stocks is declining. The U.S. market is strong overall, but the A-share market, representing the world's second-largest economy, is accelerating its decline. This massive divergence among the world's major risk markets is unsustainable and is a clear signal of accumulating structural risk. The probability of this signal is 0.85. Looking at the currency and bond markets, the US dollar index DXY is strengthening to 98.87, which usually pressures risk assets. The 10-year U.S. Treasury yield remains elevated at 4.48%, also weighing on high-valuation stocks. Yet the Nasdaq is hitting new highs under the dual pressure of a strong dollar and high yields. This divergence puts enormous pressure on Asian markets. A strong dollar and a weak yuan, with USD/CNH at 6.7874, combined with the A-share market's own weakness, will further suppress foreign capital inflows and market sentiment. The trading conclusion is clear: do not simply extrapolate the frenzy in U.S. tech stocks to Asian markets. Asian markets, especially the A-share market, will continue to operate under their own logic and exchange rate pressure, with little prospect for a near-term improvement. Looking ahead to tomorrow, Asian markets are expected to continue this divergence. Tech stocks in Japan and South Korea may try to follow the U.S. higher at the open, but the A-share and Hong Kong markets will likely open lower, with sentiment remaining under pressure. Investors will digest the massive internal divergence in the U.S. market, leading to very cautious risk appetite. There might be a mispricing opportunity. After consecutive declines, some AI-related hardware and application companies in the A-share market could be sold off irrationally. If there is a panic sell-off early tomorrow, it might offer a short-term repair window. But this opportunity is for a dead cat bounce, not a reversal. The probability of a repair window is 0.60. A key event risk tomorrow is any speech from a Federal Reserve official. After the hot PPI data, any hawkish comment could be the spark that pricks the current tech stock euphoria. The trigger path would be hawkish comments leading to a spike in Treasury yields and the dollar, followed by a pre-market pullback in Nasdaq futures, which would then worsen Asian market sentiment. Our strategic bias for tonight into tomorrow is to hedge, with a confidence level of 0.65. However, without a clear negative catalyst, we should not actively build large short positions to avoid being squeezed in a strong momentum market. The total probability assessment for today is 25% up, 45% sideways, and 30% down. The market is walking a tightrope. Risks are accumulating, and investors should remain vigilant.